Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And we are looking at a macro environment that doesn't have a whole lot going on today. So we're going to take this opportunity and use it. We are going to look at every major piece of the economic narrative that matters. And I want to underline that very clearly, that matters, between now and the next big shoe to drop in that narrative, the March 22nd Fed policy announcement. And so what we're going to do is quickly, because there's a good bit of stuff that's going on here, we're going to explain why this is the narrative that matters, and why a lot of other kind of sub and micro narratives do not. And then we're going to look at what is going to shape that narrative between now and when the Fed is going to tell us in formal terms what the next step is going to be. So, the first thing we're going to do here is look at why this is the narrative that matters. What you see in front of you, the orange line, is the implied rate in Fed funds futures 12 months from any given day. So 12 months from now, 1 year forward. You can see that where this topped, which was tellingly mid to late October, early November, is also the place where the OFR Financial Stress Index, this is from the Office of Financial Research, that's a U.S. government entity, where that index started to fall, having been rising with rate hike expectations all of last year and from the middle of 2021, where the Fed really started to talk up that inflation is not a transitory thing and tightening of a significant magnitude was going to happen. So, we can very clearly see here, as the market stopped speculating on too much more tightening, we got a decline in worries that this tightening is going to hurt credit access for all corners of the economy. We can see very clearly that as that index started to come down, the S&P 500 started to come up. We can see, in fact, a very, very clear inverse relationship here, beginning with early 2022, once the Fed actually started to do the hiking. So, not surprisingly, then, if we take it one step further, we can see that every major S&P 500 rally over last year, and certainly this latest one, has come when the 12-month Fed policy outlook has stalled. You can see that happen over the summer. So you can see there's that rally where the orange line stops and idles, essentially once it crosses 3 and before it crosses 4. And you can see that once it starts to move back higher, another sell-off. Once it stops moving higher in earnest and starts to flatline around 4.5, the S&P rallies, and that's the rally that we're with currently. You can see that as the orange line has started to move higher again and is actually starting to set higher highs in and around the recent moves that we've seen this month, the S&P has stopped rallying and has stalled. This is why this is the most important narrative. The S&P is a diversified index. Every kind of sector is in it. It is nice and big, broad, and all of these companies are, for the most part, multinational in scope. So the really big movers for the S&P derive their earnings not just from the U.S., but from the globe at large. And so what you're looking at here is the collective confidence in the global economy, which of course is going to be the generator of earnings for all of these companies. And of course, markets are forward-looking. So you're seeing not necessarily realized earnings, but confidence in the future earnings for these companies reflected in the S&P. Those earnings come from global economic activity, in particular consumption. And what you're looking at then is that being very distinctly moved by a single central bank, which of course isn't surprising. The dollar is such a ubiquitous unit of exchange in global commerce that when you increase the borrowing cost of dollars, you increase the hurdle rate on financing any economic activity almost anywhere, with the possible exception of those parts of the global economy now completely cut off from the dollarized commercial system internationally. So think North Korea and increasingly Russia, to some extent Iran, less so. So outside of these kinds of situations, the dollar is ubiquitous, and so increasing the cost of borrowing it is a hurdle everywhere. This is why this is the story that matters for everything before any other narrative. Now, what we've seen over the course of this month is the implied yield curve for the U.S. has shifted higher. And so what you're seeing now is a peak in rates that's a little bit later in the year. You can see it's about 6 months out from now, which would set it somewhere around August. And you're seeing it now well north of 5%. So even a little bit more hawkish than what the Fed gave us in December, which was north of 5, but only marginally so. And at this stage, the markets are actually more hawkish than that Fed outlook. At the time, the Fed outlook was more hawkish than the markets, and they didn't buy it. What we're looking at here has been somewhat of a shift. And so if we look now, what has happened with expectations for the adjacent policy meetings? There is no Fed announcement in August. There is an announcement in July. There's an announcement in September. And so you can see here what's happened with the implied likelihood for rates at those meetings. And you can see the peak seems to be in July. And by September, we seem to be essentially holding the line. So that's the picture that we're looking at. Currently, that's the rise this month, largely thanks to guidance from the Fed. Strong jobs data is a huge part of this story, which we'll get to in just a second. And the retail sales number, of course, that followed as well this week. Likewise, the slightly hotter CPI reading. So this is where we currently stand. This is the narrative as it presents itself ahead of the next 5 to 6 weeks before the Fed convenes again. Now, what is going to move this story between now and then? First, we're going to start with the PMI numbers next week. This is not the world's most market-moving indicator, but it is a very good gauge of the business cycle and much more timely than GDP. It actually tends to approximate GDP quite well. So what we see here is the expectation for a move up to 47.2. In the logic of PMIs, that's still contraction in the U.S. manufacturing sector. 50 is that key dividing line between contraction and expansion. Above 50 is expansion, below is contraction. The further you go, the faster each one is. The further above 50, the faster the growth. The further below 50, the faster the shrinking. So if you look at what we're expecting here, a bit more normalization, a bit of easing in the contraction of the manufacturing sector in terms of speed, but still contraction. And obviously, you can see here the trend pointing down on exactly the same timeline as the Fed tightening starts, because, of course, that tightening, again, is discouraging economic activity by making borrowing more expensive. Next, we're going to have minutes from the last FOMC meeting. And here we should get some guidance on where the Fed is heading next. It will be backward looking, but of course, the Fed understands very well that this is an indicator that markets look at. It's not as if the minutes from the meeting are an exact accounting of who said what when verbatim, and by the way, when a policymaker ducked out to the restroom, that's there as well. No, this is a massaged document. The Fed knows the market looks at it as guidance. It releases a kind of editorial summary of what was said and releases it with full knowledge that the market will be paying attention. So if the recently hawkish rhetoric we've gotten from Fed officials marries with what the Fed wants to deliver for markets in this announcement, especially given the large gap in between the early February and late March FOMC meetings, if it wants to contain the market's animal spirits and keep inflation from getting out of hand in between these announcements, well, then you might have a hawkish tilt here that moves this narrative. And so the markets, of course, in their extreme focus on this narrative, will be paying very close attention to what's in this document. You can see here, looking at the overall view of what is currently expected, you have one hike of at least 25 basis points fully baked in for that March meeting. It looks like we're going to have another somewhere in between May and June. So you can see by the time we look at June, there's already a rate change of 59 basis points relative to where we are currently. So that would be at least one hike at 25 and then another. And then we kind of top out. So as we get later into the year, you can see we never really get to 75 basis points or more north of where we are currently. If you look at that implied rate delta column, third one from the right going in, then you see we start to drift a little bit lower, and by the end of the year, we're looking at maybe the likelihood of a cut. So it looks like about 25 basis points of the hiking starts to be given away by January. That's the baseline. So relatively soon for a pivot into easing here by the end of the year and into early 2024, thereabout. Anything that clashes with this view in a hawkish direction is likely to give us a risk-off response in markets, a stronger dollar, higher yields, and probably a very wobbly, very worried sort of tone in U.S. and indeed in global shares. Next, we are going to look at the second revision of the Q4 GDP number. And here we're actually expecting an upgrade. The initial was a better than expected reading of 2.9. It looks like we might get a little bit of a bump higher to 3. Now, normally this would not be a big deal. This is a revised version of a number that's already been out. Given how jumpy the markets are about all things Fed adjacent, it could have more of a response, more of a reaction function this go-round than it's had, especially if it's going to surprise to the upside. The other interesting thing in the second revision of GDP is we get to see more of the components. So which part of GDP growth accounts for more or less of the overall rise. So seeing the breakdown there should be at least somewhat informative. If it looks like, for example, that government spending is a big component or an outsized component relative to history, that would be significant as relative to, let's say, if exports or consumption were more so dominant. Generally speaking, household consumption will be overwhelmingly the biggest piece at 75% of GDP generation. And from there, we sort of push back and say, okay, at the margins, the remaining 30, 25, maybe even 20 of GDP, where's the greater influence? And that can be somewhat informative, somewhat market moving, considering the Fed has generally concluded that goods inflation is coming off. The problem is services, and in particular, services exclusive of housing. So there may be some nuances in this report that inform the narrative in a market-moving way. You can see here what that would look like overall. So the upgrade would essentially be something in line with where GDP has averaged in and around the post-COVID volatility. Obviously, through the lockdowns, you can see we had one quarter where the economy was shrinking by a third when you annualize the rate, and then, of course, expanding by a third immediately thereafter. This is obviously not normal GDP dynamics. This is the consequence of a mandated lockdown and then a mandated end of those lockdowns. So by and large, it looks like we're back to kind of middling economic growth in the U.S. Not good, not bad, right around where it's been in the last several years. Now, CPI comes next, as does PCE. PCE first, CPI significantly later, but in so much as this is the same narrative, we're going to look at them at the same time. And here, one chart really says it all. So you can see that when we lag these indicators just 2 months relative to the priced-in inflation expectations reflected in short-term break-even rates, these are the difference between nominal and inflation-adjusted bond yields, which, of course, return the magnitude of that inflation adjustment, which then gives you the priced-in inflation expectations in the bond market. We can see the bond market has anticipated the turn in inflation about 2 months ahead, which, of course, is what you would expect. The data itself is lagged because there's time that it takes to collect the data, to put it all together, to push it. So there's that slowdown. And of course, the markets are forward-looking in general. They anticipate the business cycle. So you have a situation here where about 2 months for the headline CPI and the headline PCE numbers is the lead that you have relative to expectations. And so if that continues to be the case, then two things stand out. Number one, inflation expectations are rising again in February. At the very least, they seem to have kind of flatlined over the past several months. Let's call it the past 5 months or so. February is obviously not over, but give or take the past 5 months, 4.5-ish. Inflation seems to have stopped the precipitous decline that we saw in the first half of last year. And so one might expect, if this relationship holds, and hold it should, I would think, given how consistent it has performed recently, then we are looking perhaps at CPI, PCE numbers that are going to turn up with these expectations. And we're getting a view into a Fed that may then hold rates higher, maybe even move them higher than is currently expected. But this, of course, is a meaningful concern for risk sentiment, a meaningful concern for stocks. Next, we are going to look at the ISM manufacturing PMI. This is a sort of U.S.-centric alternative to the S&P Global PMIs. The Institute of Supply Management publishes this series for the U.S. and Canada. And here we are going to get a little bit more detail here, similar to what we see from the S&P Global number, which you can see there on February the 21st. That's next week. a reduction in the pace of contraction, but still contraction. The ISM number works on the same 50 above and below sort of logic. Here, you can see we're expecting to rise, and it's the first sort of month-on-month crack of the losing streak in quite a while, basically since the summer. And the real important thing to take away here is, of course, employment has been a key point of resilience in the U.S. economy so far. And what you see inside the details of this particular survey, which are very, very helpful, is that the overall index has been declining along with new orders, whereas employment has held basically steady since the recovery from COVID hit its peak around the first half of 2021. You can very acutely see here that there's a lag between the decline in new business and employment, which is essentially sitting at 50 idling. So, with this in mind, we have a situation where what we're going to look for is either new orders are going to tick up or employment is going to catch up down. We'll see what the makeup is. And arguably, this captures exactly where we are in the current business cycle in the U.S. We, of course, hear all manner of fire and brimstone from the last earnings season, from the guidance that corporates gave us. That would be consistent with that decline in new orders that we see here. And so we have a situation where the path of least resistance has been lower for that narrative. The overall index has been moving deeper into contraction, and employment has been sticky. So it could be that this is the shoe left to drop. It could also be, as we saw in the services ISM number for last month, that the resilience in employment gives us a bit of a rebound in new orders, a bit of a rebound in the overall index. So definitely something to watch for what the moving parts are and what the Fed is going to be responding to. Then, of course, we get the big one, the March edition, and this will be February data, but it will be released on March the 10th, of the jobs report. Here's where we are. You can see that there's been significant revisions to this series last go round, and they've actually pointed mostly higher. So you see that there's been a slowdown from about the middle of last year until this last number at 517. And of course, we're now at essentially record low unemployment for the U3 rate. This is the one that is sort of the most widely quoted number that excludes folks that are not in the labor force because they are so-called discouraged workers. They've stopped looking or are of working age but aren't actually engaged. So you have here a jobless rate on that measure of 3.4%. If you included folks that were, let's say, of working age but not seeking employment, students, for example, then it would be marginally higher, but the trend would be exactly the same. It would be pointing very firmly lower, just a bit of a level higher. But the trend, nevertheless, is very robust. The state of the jobs market still looking very resilient, but of course, that's exactly the thing that we just saw in those ISM numbers, that forward-looking indications of economic activity are moving lower. Labor is, for now, resilient, but labor is a lagging indicator. And so we do have a level of concern that it might have to catch up on the downside here invariably as this tightening works its way through the economy. And in fact, the Fed has said as much. They've said that they don't see reaching a level that's restrictive enough on policy until there's pain in the labor market. And that's not obvious at this point. So if we get another strong round of numbers, this next go round, that would contribute again to a more hawkish Fed view. Then we're going to group some retail numbers here. The retail sales number for February, as well as the University of Michigan Consumer Sentiment report. Not a big story to tell here on retail sales. Obviously, the number we saw this week was meaningfully better than expected, and actually the strongest retail sales number that we've seen since the first half of 2021 on a month-on-month basis. Arguably, again, this is something that encourages a more hawkish Fed, and probably, we talked about this in detail earlier in the week as we looked at that retail sales number in detail, probably a reflection of how resilient the labor market has been so far. And that is as open of a question as it's been and remains. Will the labor market catch up down to the overall weakness in the economy, or won't it? Time will tell. And we can see the same thing on consumer confidence. In fact, since the middle of this year, we can see consumer confidence has gently moved higher, both in terms of people's expectations going forward, in their assessment of current conditions, and thereby the overall sentiment index here in the red. That would, of course, be consistent with building into a pickup in retail sales, building into a pickup of economic activity at the consumer, at the retail level. And since household consumption, as we've just said, is the biggest contributor to GDP, this is ostensibly good news. The question is how sustainable it is, and that, again, takes us back to the labor market. And then, of course, we arrive March the 22nd. This will be the announcement where the Fed is currently baked in to give us a rise in rates of 25 basis points. So you can see the range bottom there going to 4.75 from 4.5, the range top going from 4.75 to 5. And so this move already fully baked in. The question is, of course, will any of these economic indicators over the coming weeks give us something that's higher, give us something that's lower, or alter this in any way? And what kind of volatility we are going to have around it as these numbers hit the tape? The path of least resistance so far this month, after months of standstill, has been a correction upward in rate hike expectations and a much gloomier sense emerging in overall risk sentiment. That affects stocks, that affects certainly gold, which has been deeply hurt by rising interest rate hike expectations. That affects the dollar, which has lifted itself off the mat after a shredding over the past several months. It has impacted virtually every corner of the financial market universe and is probably going to continue to for some time yet. And this has been Macro Money. I am Ilya Spivak, head of Global Macro here at tastylive. Outside of this show, which happens Monday through Thursday every single week, we're going to be off for the U.S. holiday on Monday next week, actually. And so there will only be Tuesday through Thursday shows, but generally we're here Monday through Thursday. And that follows on from overtime with our friend Chris Vecchio, head of Futures and Forex at tastylive. In the interim between those times, if you want to follow my analysis, you can do so on Twitter at Ilya Spivak. Thanks very much, everybody, for joining. Good luck out there. See you soon. Godspeed.